Thank you very much. Thank you for sharing your Valentine's Day with me, although I imagine it was involuntary on your part. And I'll do the best I can with that responsibility. Before I start, I want to say a few things. First of all, Oaktree is a alternative investments manager, but multi-strategy. And we have 15 to 20 different things we do. So it would be hard, obviously, to cover them all tonight. And obviously, they don't all operate the same. They all follow the same investment philosophy. And that is an absolute requirement of everything that Oaktree does. It's an investment philosophy with 6 tenets. The first one is that our number one job is risk control. And the second one is that we're after consistency, not highs and lows. Those are the two most important. After that, we are only active in markets we believe to be less efficient. We practice a high degree of specialization, and each of our funds does one thing. Each of our people does one thing. We do not premise our investments on macro forecasting, and we do not actively raise and lower cash to time the markets. So that's our investment philosophy. Everything we do follows them. The reason I started Oaktree is because that's the way I think I should manage money, and I think it's a good way. I don't necessarily think it's the only way, but it's a way for me and for us. And we started the company so that we could have a company that runs our way. Everything follows that, but everything doesn't operate the same. Our strategies range from convertible bonds to high-yield bonds to leveraged loans. Those are our marketable. Distressed debt, distress for control, real estate, mezzanine finance, and power infrastructure. Those are our closed-end funds. And then what we call value opportunities and emerging market equities. And those are our evergreen or hedge funds. So obviously, with that diversity of things we're investing in, I can't tell you about all of them tonight. And I can't describe one methodology which covers all of them tonight. So my comments will be either general as to what Oaktree does, or when I have to be specific about how we operate in an asset class, I'll be talking about distressed debt. And distressed debt is, I think it's probably the thing we're most famous for. It's the biggest contributor to our profit margins. It's probably our biggest asset class in terms of assets under management. And it's also one of the areas in which we have the highest return, certainly the longest record at the highest level. So I'll be talking about distressed debt when I get specific. And I'm going to leave plenty of time for questions at the end, and I hope you will take advantage. If you want to get your money's worth on Valentine's Day, you'll be sitting there thinking of questions. Number one, so I have this outline from the professor, and I'll try to stick to it. It makes life easy. Number one, what principles do we apply in searching out opportunities for detailed study? And I think that the common theme throughout my career has been that the best bargains are found in doing the things that other people don't want to do. You know, I was privileged to attend the University of Chicago in the 60s, where I was taught about the efficient market. I do not dismiss the premises of the efficient market. I think they're very important, and I think we should bear them in mind. And I think that some markets are efficient, or more efficient than others. And it is obviously true that where everybody knows about an asset class, is happy with it, feels they understand it, finds it acceptable and not controversial, et cetera, with the developed infrastructure and developed data supply and so forth. It's clear that those kinds of conditions attract a lot of people. When you have a lot of intelligent, motivated people picking over an asset class, it makes total sense that that should tend most of the time to drive out the bargain. So we want to be in the inefficient asset classes, or less efficient, because I don't think that any are perfectly efficient, and I don't think that any are totally inefficient. We want to be in the less efficient. What are the things that make asset classes less efficient? And they are the opposite of what I said. The asset is not understood, not known, there's no data, there's no infrastructure, the recent performance has been bad, there's some scandal tinged with them, but for any of a variety of reasons, people are against them. When people are against them, we're for them. And really, the turning point in my life occurred in '78. Anybody in that audience ever hear of a guy named Michael Milken? You. Okay. Well, in 1985, Milken was the most famous person in the investment world, much more so than Warren Buffett or anybody else. And in 1978, I got a call at Citibank, and my boss said, you know, there's some guy in California named Milken or something, and he deals with high-yield bonds. And the client has asked for a high-yield bond portfolio, and we want you to go to California and figure out what they are and deliver. And that was the turning point in my life. And, you know, high-yield bonds are bonds rated below investment grade. Investment grade is AAA to BBB. High yield is BB, single B, on down, and T's and the D. And what do you think Moody's had as a description of a B-rated bond in 1978? They said, fails to possess the characteristics of a desirable investment. That's what they said. It's a bad idea. Now, if I had, rather than teleconference to the Ivy School, if I had driven over, and I took you down in the parking lot, and let's say you needed a car, and you had money, and I said to you, would you like to buy my car? You look it over. Hopefully there's one question you'll ask before saying yes or no. What is that?
Can you drive it?
No. How much? The question is, what's the price? You don't know if it's a good buy or a bad buy until you know the price. And hopefully you wouldn't say yes or no before you know the price. So how can Moody's say that B-rated bonds are a bad idea before they know the price? Anyway, the point is that Moody's and the world were biased against B-rated bonds. And it makes sense to think that if the world is biased against an asset class or a specific asset, that the price will be lower than it should be. Or the yield will be higher than it should be. And that was basically the case in high-yield bonds. And high-yield bonds have vastly outperformed high-grade bonds on risk-adjusted terms, absolute terms. They've outperformed equities in the last 13 years, and maybe for the whole 35, I haven't really looked. They've outperformed almost any other class of securities. Why? Because people hated them too much. And so one of the criteria we have for things is that people dislike it. Some of the other things we look for in the assets we're going to research are, number one, we apply patience. We let things come to us. We generally do not put together a buying list of the things we want to buy. The things we want to buy, well, we're going to drive up the price if we pursue them. It's much better to buy from the list of things that other people are desperate to sell. That's where you find the bargain. So patience is important. Opportunism, likewise. We would rather rush at the things where we get a call that says so-and-so wants to get out and they need to be out by the end of the month. Can you help? We really rather help them than try to cajole somebody into selling something they don't want to sell. We have to be ready. We have to be ready with analytical models. We have to have research, the cause celeb of the day. We have to have prepared on the troubled industries and the troubled companies. But we never know what company is going to have be in the negative headlines on a given day. And importantly, we never know what bonds are going to come up for sale on a given day. And it's really, as I said, from the list of things other people want to sell that we do most of our buying. Now, contrast our activities with some other investments. Let's say you invest in the large stocks. What do? You put together the list of things you want to own, and when you've decided which ones you want, you send an order to the floor and you buy it. And basically, you can buy any of the major stocks any day. And in some of them, you can get all you want. That's not our deal. What happens in our asset class is somebody calls up and says, there's 10 million for sale. You take it. Or 15. But there is no trading place central, there's no exchange, and so we have to wait patiently and opportunistically. At the other end of the spectrum from the common stock buyer, there are the private equity firms. And they're approached by an investment banker. They say, company XYZ is for sale, or company XYZ is attractive. Why don't we look at it and figure out if we want to make a bid for the company? And they spend a couple of months figuring out whether the company's worth buying, and at what price, and how they would buy it. And then they launch a bid, or they put a bid into an auction. So that's not us either, because we're not offered the chance to buy the whole company, or even a good part of it, or even a good part of the debt. Rather, pieces come up one at a time. So we have to be ready, but we have to be, as I said, opportunistic and patient. And lastly, we want to be contrarian. We want to buy the things that are out of favor, and we want to buy in a market that is good for buyers, not good for sellers. Those are the generalities. Now, in distressed debt, what are the things we want? Well, the main thing we want is, first of all, our mantra is good company, bad balance sheet. If you have a company which is a good company with good management, good product, good markets, etc., and just too much leverage to be viable because it's engaged in a growth spurt on borrowed money, or is subject to a leveraged buyout at a high price with a high debt equity ratio, that's easily fixed. A good company with the wrong balance sheet can be fixed through a balance sheet restructure, either outside of bankruptcy or by going through bankruptcy if they become insolvent. And what you do is you say to the judge, we have too much debt, we don't want to have this much debt. The equity is out of the money, the junior classes of debt are out of the money, let's wipe them away, and let's extinguish most of the senior debt, and in exchange give those people the company. That's an oversimplification, of course, but that's basically what happens in a restructuring, a debt for equity restructuring. The way I describe it, in bankruptcy, the old owners are wiped out, and the old creditors become a new owner. So it's relatively easy to fix a good company with a bad balance sheet. It's hard as heck to fix a bad company. If a company has bad products, bad markets, bad management, think of the heavy lifting you have to do to fix it, and think of how unlikely you are to succeed. If the best batter in baseball history got 4 hits for every 10 trips to the plate, how often do you think, how dependably do you think one can fix a troubled company? So number one, we want good company, bad balance sheet. Number two, we prefer certain industries. Not because of emotional reasons, but because if a company goes through a bankruptcy, it has to endure a lot. And we want companies where the cash flow will hold up, the reputation won't be damaged too much, maybe they can keep doing business, maybe the competitive position won't be damaged, and where the assets won't deteriorate. What are some examples? Well, in about 1999, virtually all of the cinema companies in the United States were insolvent. And we obtained control of 5 or 6 of them, and other opportunistic investors got some of the others. And they turned out to be a great investment. And among other things, nobody ever said to his wife or girlfriend or boyfriend, you know, it's Saturday night, let's go to the movies, but we can't go to that movie theater because they're bankrupt. Maybe they won't show the end of the movie. But if you were going to build a bridge, and the bridge building company was in bankruptcy or threatening to go bankrupt, you might say, well, wait a minute, maybe we shouldn't contract with them because maybe they won't be around to finish the deal. So you can imagine that there are differential effects of bankruptcy on different companies and different industries. And so we want companies which are solid. The other things, at the other extreme, we learned a big lesson. We've always stayed pretty much away from technology. Technology moves so fast, and assets and positions deteriorate so fast. But we thought we had a good investment. We bought into a distressed company that had a technological advantage in producing sound cards. And the sound card is the part of the computer that talks or makes the noise. And they had a good position. We got control. But guess what? If you don't keep investing in a technological position, 6 months later, you lose your lead. And that's what happened to us. And I suspect that we lost all our money. That was perhaps our only total loss in history, or one of very few. But that'll show you the difference between lasting and ephemeral assets. And of course, we want the lasting kind. So those are examples of some of the kinds of things we look for. Of course, we're looking for value, and that's the ultimate. We want companies with good, enduring value. It's better if it's value that other people haven't recognized, and we want cases where the value exceeds the price we have to pay. That stuff's obvious, but you all know that. Second question, what kinds of information and securities are we seeking? And I think that the bottom line is there are two things that we have to understand on which we need information. The first, of course, is the company. And so, like anybody else, like all of you, like the stock investors and the private equity investors, and even the bond investors, we have to know the company, its assets, its earning power, its strengths, its weaknesses, its potential, its traps. We have to know everything we can about the company and assess the management, the products, the growth potential, etc. But in our case, and by the way, I said I think that our areas are less efficient, but clearly the stuff I just described, the basics of the company, everybody can know. And if you think about it, you know, the essence of the securities laws in the U.S. is that information should be dispersed by the companies so that everybody knows everything and knows it at the same time. So when you talk about being a less efficient market, when you talk about getting an information advantage, it's hard to imagine that you can do much of that with regard to the company. I don't think that we get that much of an edge in understanding the company. But what we might understand better than others is the capital structure. You know, how indebted is it? When is it going to have to pay? Which bonds come first? Which bonds come last? There may be bonds of a single nominal standing, like senior secured or unsecured or whatever it might be, where if you read the indentures, you find that some of them are really better than others. So here you can get an advantage through hard work and skill because not everybody works as hard. The other thing that people may not all know the same about is what we call the bankruptcy dynamics, which is who owns each class of debt. Are they easygoing or hard chargers? Will they give up and walk away, or will they insist on getting all they're entitled to and more? Some will put up a fight, some will recede. The good thing is we can know who the other people are. It's a small community. We can have a sense for how they might behave, what their motivations are. How many of the creditors are original creditors who actually made the loan, and how many are people who bought it in the secondary market. If somebody loaned $100 million, he may feel different about taking 75 than somebody who bought in at 20. So it helps to know who the other people are, what kind of people they are, what kind of money they represent, what their goals are. We also might like to know, if bankruptcy, which court, and maybe even which judge, because different courts are either creditor-friendly or debtor-friendly, and that might make a difference to what we're doing and to projecting the outcome. So we want information about the company and about the bankruptcy, and we think we can get an advantage in the latter. We've been doing this since '88, so it's 25 years this year. It'll be 25 years in October. There aren't many people around from 25 years ago, and we've been through 3 crises, and I think that experience gives us an advantage in gaining information and insight. Number 3, what kind of investor irrationalities do you consider? Well, if you read the book, and I assume that you either all have or all will, and hopefully many different copies, so you know that irrationalities, not my word but the professors, are very important. If everybody, you all know about the efficient market hypothesis? Yes. Okay. So in the efficient market hypothesis, everybody is objective, clinical, and rational. And these are the building blocks. And if everybody were those things, and if everybody worked hard and got all the accessible information, it's reasonable to think that markets would be efficient, which means you can't beat them, which means there's no such thing as a free lunch, which means there's no such thing as superior risk-adjusted performance. And so we are looking for what the professor calls, what the academics call inefficiencies, what the professor calls irrationalities, and what I call, using a highly technical term, mistakes. The efficient market hypothesis says that the markets don't make mistakes. They price every asset right. And when they price the assets right, you can't get a bargain. You can't overpay, you can't underpay. Everybody does about the same. You can't beat the market. And it is true that if you look at the stock market, the returns are relatively tightly clustered. Dave Swenson of Yale has a very good graph in his book to that effect. You get in the highly liquid asset classes, you get tightly clustered performance because they are rather efficient. We're looking for mistakes. We're looking for times when markets are mispricing assets. By the way, let's clear up a notion right now. It is not true that inefficient markets give superior risk-adjusted returns. What an inefficient market does is that it contains pricing errors, meaning that it is possible to have superior or inferior risk-adjusted returns. If you buy, if the market were efficient, and if everything were priced at its fair value, then everybody would have fair risk-adjusted returns, and everybody would perform the same. If you want to be in the investment business and practice so-called active investing as opposed to passive indexing, why would you want to do that? What is your raison d'etre? That's a French word. You may know that. You may know that word in Canada, although not Toronto. But the active manager is active because he thinks he can get superior risk-adjusted returns. And if buying things at a fair price produces fair risk-adjusted returns, then to get superior risk-adjusted returns, we must buy things below their fair value. And that's what the active investor exists for, is to buy things for less than they're worth. There's one problem. Doing so requires cooperation from someone who's willing to sell it for less than it's worth. Think about that. Don't ever forget that. And I wrote a memo this summer called "It's All a Big Mistake." And I said that in every transaction, usually somebody's making a mistake. And if you think you're buying it too cheap, then somebody else is selling it too cheap. Number one, why would they do that? Number two, maybe you're wrong. Maybe they know more than you. Maybe you're the one who's making a mistake. So, merely being active in inefficient markets is not a gift of a free lunch. It's a gift of an opportunity to have performance which diverges significantly from the universe act. And that's what we're looking for. So I did want to digress for a minute on the subject of rationality. That is what we look for. So what do we look for specifically? Well, our pond of opportunity, pond we fish in, when it is well stocked, is stocked because financial institutions primarily were engaged in what I call the unwise extension of credit. Every lender, pretty much, knows how to make a loan which will be repaid if conditions don't get worse. You have somebody who's making $100,000 a year, he says, I'd like to borrow $50,000. You conclude that he can pay you $10,000 a year and pay it off in 5 years plus interest. So you lend them the money. And most loans that are made can be serviced if things stay as they are. But the unwise extender of credit makes loans that will not be repaid if things get a little worse. In other words, he fails to build in sufficient margin of safety or margin for error. Those are two terms that Warren Buffett uses interchangeably. Margin of safety is the title of Seth Klarman's great book. And you know, Seth Klarman, the manager of Baupost, is one of the great investors in our business and has been for decades. So one of the keys to successful investing is building in sufficient margin for error, but people don't always do that, especially when the music gets playing. And you may all recall, anybody, raise your hand if you remember Chuck Prince. Two hands. How quickly they forget. Chuck Prince was the CEO of Citibank, and he got famous because in June or July of, I think it was June of '07, he said, while the music's playing, you have to dance. That's what he's famous for. He actually said something more significant than that. He said, all of this is going to end badly when the liquidity dries up. But in the meantime, the music is playing, and when the music is playing, you have to dance. Which basically means that if you're a lender, you have to lend. And, you know, I tend to disagree. I think it would be better if when you heard the music playing too loud and too fast and too crazy, you said, you know what, I'm not going to dance. We have the luxury of doing that. I guess maybe Citibank doesn't have the luxury. I said at the time that it's too bad. In '05, he should have said, you know what, the music's playing too fast, we're not going to dance at Citibank. And there's only one problem with that, which is that he would have lost his job in '06. Because some hedge funds would have said, there's all these smart loans being made, and all the other banks are making them, Citi's not making them, and Prince is stuck in the mud, so we have to have a new CEO. And that probably would have happened. As it was, he made the loans, and so he didn't lose his job until December '07. But the point is, people do extend credit to excess when the music gets going. And then, eventually, there's a recession or some other problem, a credit crunch, and it turns out that those were bad loans, and they don't get repaid, and they fall into our pond, and that's how it gets stopped. So if you think about it, and I hope you'll go back and read this memo. All my memos are available on the Oaktree Capital website, and there's a little box in the upper right-hand corner that says Chairman's Memo, and you can look at the last 24 years' worth and download them, and you can even sign up for a service that will tell you when there's a new one. So look at this one called It's All a Big Mistake. And basically, I wrote that memo because I was listening at our investor conference in the spring. Maybe I wrote it in the spring, not the summer. And I heard one of our guys who was presenting a case said that a lot of what we do is the exploration of overly excessive assumptions, overly optimistic assumptions. And so we look for loans that were made on the basis of too optimistic assumptions with inadequate margin for safety, where times have turned bad, and it's turning out that those loans are not going to be paid. And that scares the hell out of people. And people, people swing like a pendulum from too optimistic to too pessimistic, from behaving too safely to behaving too worriedly. And so when they're not worried about safety, people make dumb loans. And when it turns out that the loans will not be paid, they worry that they're worthless. And of course, it's at that point that we go in, because if people think it's worthless or worth less than we do, and we can buy it from them at that low price, maybe we can get a bargain. So unrealistic assumptions and expectations is a very important part of the rationalities we consider. And the other, as I mentioned way at the beginning, is excessive dislike. If you're going to buy something for less than it's worth, excessive dislike on the part of others is a great explanation. And if you think you can spend your career buying things for less than they're worth, you have to give a lot of thought to what it might be that would position an asset as such. I mean, it's silly, it really turns me off when I hear people say, oh, we buy bargains. We buy companies that'll go up. We buy things where we can get high returns. What are the underlying processes? What are the things that will make assets available to you for less than they're worth? If you can't explain that, then I would recommend another career. If you can explain it, that's the first step towards being able to find those things. But I wouldn't screw around otherwise. Number 4, question 4, what periods lead to greater or lesser investment? And, this is clear. Buffett said, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. In other words, when other people are unworried, we should be terrified. And when other people are terrified, we can turn aggressive. And I think this is very, very important to bear in mind. So we want to be attentive to the swing of the pendulum. We don't want to buy when there's optimism. We want to buy when there's pessimism. We don't want to buy when people are greedy. We want to buy when people are fearful. We don't want to buy when people are credulous. We want to buy when people are skeptical, and so forth. And so that's the general. That's what a contrarian does, and that's what we look for. Pessimism, periods when investors are chastened, panic, forced selling. So let's talk for a minute about the conditions that give rise to the kind of markets we're looking for. First, we have the cycle moving up. And when the cycle is moving up, we have strengthening the economy, good corporate results, rising asset prices, rising enthusiasm and optimism, easy financing, and all of the conditions that give rise to overpriced assets.
And because the conditions seem so favorable and investors are so sanguine, they engage in risky behavior. Risky behavior does not fall apart right away. As long as the environmental conditions remain sound, risky behavior is rewarded, not penalized. But if there's a recession or a credit crunch or some exogenous events, then the market will turn down and the enthusiasm will turn to fear, and we'll get the bargains we look for. So we look for the swing back of the pendulum. We look for periods when former unwise decisions have been exposed. Let me give you some examples to try to put some flesh on the bone. I mentioned that we started our first distressed debt fund in '88, started the first high yield bond fund in '78. Our first debt crisis, you know, the 80s were a very good decade. Good economic growth, a lot of it recovery. You know, you push down on a spring long enough, you let it go, it bounces up. We had a good economic recovery in the 80s, and lending worked, private equity worked, leverage worked, and of course, you know, when you read the book over again, you'll see that my favorite adage is that what the wise man does in the beginning, the fool does in the end. So, you know, the smart person bought assets in 1980 when they were on the bargain block, or in the 70s, and the whole market of stock, the stock market in the 70s, was that you could, if you wanted to have a company that was in the XYZ business, you could buy it cheaper on the stock market than you could create it. Why go to the trouble of getting a charter, building a building, hiring workers, getting machinery, getting trucks, getting raw materials, and all that stuff, when you could just go to the stock market and get it cheaper? So obviously, if you bought in that environment, and if you bought with leverage, you made a lot of money. And private equity worked out extremely well in the beginning. But what the wise man does in the beginning, the fool does in the end. So in the late 80s, iconic American multi-billion-dollar companies were bought at not low prices, but full prices. Sometimes as a result of bidding wars. Read, for example, Barbarians at the Gate, about the battle for RJR Nabisco. And they were bought with 95, 96% leverage, 4 or 5% equity. So guess what? We had our first debt crisis in 1990. What did we have? Recession, credit crunch, and then some scary exogenous events. The Iraqi invasion of Kuwait, the bankruptcies of most of the leading LBO companies of the late 80s, and the government war on the junk bond industry, which closed Drexel and put Mike Milken in jail, in which case financing and refinancing ground to a halt. And refinancing is a very important component of dealing with debt. So we had a 10% default rate among high-yield bonds in 1990 and 91, and we were able to get a lot of bargains from terrified investors, some of whom were getting margin calls, and the funds we formed in 1990 had IRRs, internal rates of return before fees, of 45%. And if you compare our results with some of the prominent buyout firms that you may have heard of, and if they did the same, just remember that they use 3 or 4 times leverage, and we don't use any leverage. We were able to make 45% a year on our money without any leverage. And that gives you an example of an illustration of the kind of market we were buying in. Fast forward to 2002. Now, we didn't have, because investors were chasing, we didn't have large iconic companies being bought out. Small companies were bought out and built up into large companies through acquisition. People couldn't get 95% leverage, they could get 75% leverage. And so, and then we had the next crisis in '02. There were no iconic companies going bankrupt, but there were small build-ups. There were a lot of telecom companies that had not been bought out, but had borrowed a lot of money to build fiber, and everybody did too much of it, so the fiber was in oversupply, optical fiber. And finally, we had over-leveraging for internal purposes in many places, including, as I mentioned, the cinema industry. So what did we have in '02? Recession, just like in '90. Credit crunch, just like in '90. And a new set of exogenous events. We had the meltdown of the telecom industry, where fiber was in oversupply. And we had the scandals at companies like Enron, WorldCom, Philadelphia. And we had 9/11 and the beginnings of a life with terrorism. So again, conditions were very bad. The fund we formed in '02 had an unlevered IRR of 57 before fees. Now I hasten to say that things went really south and came back really fast. It gave us a very high IRR, but since the investments paid off so fast, we didn't make a lot of money. And that fund only made, if you put in $100, you got back 170. Whereas in the first fund, which had a 45% IRR, if you put in 100, I think you got close to 300. Because the rate of return was lower, but the investments lasted long. Lastly, of course, you're all familiar with the global financial crisis of '08. Guess what? Recession, credit crunch, subprime debacle, and the crisis in general, and meltdown of CLOs. So there we made a gross return in the 20s, primarily because not many companies defaulted. When the government stepped in and lowered interest rates and recapitalized the banks, it prevented the customary deluge of defaults, and our clients had to content themselves with an IRR in the 20s rather than our usual. But making up for that is the fact that our previous funds, our '90 fund was in total about $400 million. Our '01, '02 funds were $3.5 billion, but our '08 fund was $11 billion. So they earned a lower IRR, but on more money. So these are the kinds of times we're looking for. We want to buy when pessimism is high and optimism is low. And by the way, you know, you're learning a lot of valuation and analytical techniques in this class. But what if you could only ask one question of every potential investment? If I could ask one question, it would be one thing. How much optimism is there in the price? If there's a lot of optimism, you don't want to buy it. Because if that optimism turns out to be unfounded, you're going to lose money. The price will deflate. But if there's no optimism, you want to buy it because that probably understates the reality. And if you can buy it without optimism, and a couple of good things happen, that's a way to make a lot of money. Next, 5. How do you define and estimate value? Well, this is a hard question. One of the great American justices of the Supreme Court, in a case about pornography, said, "I can't define it, but I know it when I see it." And I think that's true of a lot of value investors. We know it when we see it. But I mean, the real question is, what is this company worth today? And if we normalize the earnings and take it out a few years and complete a restructuring, what will it be worth in a few years? We use as our standard metric, what will an intelligent buyer, hopefully a strategic buyer, pay for the company X years out. I will digress into the analytical process for distressed debt. And, one of the things that I try to contribute is that I watch the analytical process, and then I try to turn it into a description that can be perpetuated, passed on, and generalized. And when I started watching the analytical process for distressed debt 25 years ago, I concluded that it's our job to answer 3 questions about every distressed situation. And they're rather cut and dry. Never easy to answer, and I'll come back to easy to answer. But the 3 questions are, what will this company be worth after the restructuring? Hopefully the earnings come back. If the earnings weren't depressed, they probably wouldn't be in trouble. The earnings are normalized. Maybe you make some improvements in management or operations. You fix the balance sheet, you exchange debt for equity, you delever the company, you get its finances on a decent footing. What will it be worth to an intelligent buyer at that point? That's question number 1. We might say, that's the pie. What's the pie worth? Number 2, how will the pie be divided up among the various claimants? So, remember I said we have to know the other creditors. Who are they? What are their motivations? What are their rights? How many are there? What's ahead of us? What's behind us? What are the different classes of creditors? In addition, what about litigants? What about tax authorities? What about, in our country, the EPA or OSHA? Are there any governmental claims, etc.? All the claims against the company will have to be discharged in the restructuring one way or the other. So, how will the value of the whole pie be cut up among the various claimants? Where will we stand? Number 3, how long will it take? Because if you can buy a piece of the pie today at a given price, and if you know what that pie is going to be worth in the future, how big your piece of the pie is going to be, and how long it's going to take, then you can figure out your rate of return. So that's our analytical model, and that's what we try to do. But of course, probably the most important single building block is question number 1. What's the pie going to be worth? If we're too high on that and we buy a piece, we may well lose money. Just being right on the other 2 questions won't matter. If we are too low in evaluating the company, we probably won't get to buy any of the debt, because our bid for the debt will always be too low. Somebody else will get it. So we can't be too optimistic. We get beat up. We can't be too pessimistic. We won't be able to move forward. So we have to have valuation. Valuation is the key to success in our business, just like all the others. Number 6, how do you factor in asset values, related security transactions, industry economics, firm strategies, management behavior? Well, of course, these are all things we have to think about. I can't simplify the question of how we do it. Obviously, we look at asset values as an alternative to going concern value. So remember what I said before. The company improved, the earnings are normalized. We look at it, what would a strategic buyer like to pay? Asset value, which is what would it be worth if we broke it up and sold it off, that's an alternative. We tend not to do that. I don't know if we've ever done that. But it is another way out of the room and might give us some solace as to what these things are worth on the downside if all the other things don't work. Worth thinking about. Industry economics, firm strategies, these things are all things we have to have a handle on. When we look at this firm strategy, in our case, is it worth keeping or is it worth changing? Can we make a suggestion, and what's the likelihood that our suggestion is right? The last thing that I will mention in this regard is on the subject of the last thing that the professor asked about, which is management behavior. Management is extremely important. In our analytical process, we give great emphasis. In our high-yield bond analysis process, we counted twice what we count most other things for. Of course, it can't be quantified. It can only be estimated. One thing you'll learn if after you've been in the business 20 years is that a lot of the managements that sound good are stupid, and a lot of the ones that are unimpressive are brilliant. And one of the most important things in life, not just investing, but life, is to try to get beyond appearances and not be overly swayed by appearances. Because reacting to appearances can do you in. But management behavior is very important, and bad management can do in a company, of course. Good management can accomplish a lot. Specifically in the debt area, I want to mention one thing. This is more true of the high-yield bond business, where we expect to get interest and principal, than of the distressed debt business. But it's something called event risk. Anybody there? Raise your hand if you know what event risk is. Raise your hand while I get a bottle of water. Oh, okay. I'll be right back. Come on yourself. Not too long to walk. Okay. So here's what event risk is. Event risk is a term that came into existence sometime 10 to 15 years ago. And I define event risk as the risk of voluntary actions on the part of company managements which are designed to put money into the pockets of the shareholders at the expense of the creditor, of the bondholders. And it's an interesting thing. I hope you're aware that boards of directors have a general fiduciary responsibility to protect the interests of shareholders, who are the owners of the company. And the directors of a company are the representatives of the shareholders. They work for them. I don't know if you've ever thought about it. You guys are probably stock guys and not bond guys. Not too many people take the bond classes in university. But the directors have no comparable duty to the creditor or the bondholder. If it's not prohibited by the bond contract, which is called an indenture, and if it's not prohibited by law, then the management can do it. And some few extreme examples exist where managements felt that they could, and in fact had a responsibility, to take money out of the pockets of the bondholders and put it into the pockets of the shareholders. And so, obviously, this is something that we bondholders have to be extremely wary of. What does this mean? What's an example? Well, around the time that the term was coined, one of the contributing factors was the fact that there was a hotel company. And this hotel company issued bonds. And because the hotel company owned a bunch of hotels and real estate, people said, well, that's a pretty good risk. The bonds are well protected by asset value. We're going to take that risk and buy the bond. And the company didn't have to pay too high an interest rate. And a little while later, the bondholders woke up in the morning And they found that the company had split in two. And the bonds were in Company A, were the obligation of Company A, and the hotels were the property of Company B. And it was taken to court, and it was perfectly legal. Obviously, the bonds, which no longer had the security of the real estate, became a much riskier proposition. But the directors of the company could not be prevented from doing it because it wasn't prohibited in the indenture. So we have to understand the motivations of our companies, and regardless of how much we like the management, we have to prohibit the actions that we don't like through what are called covenants. And bonds, debt, carry covenants. You might have heard of covenant-like debt, which was issued before the crisis and contributed to it. And we like covenants. Covenants prevent management from doing things we don't want them to do. They might have to maintain a certain net worth. They might create a limit on the amount of cash they can distribute in dividends. It might put a limit on asset sales or asset distributions, any number of things. But covenants are our greatest protection. And so we want to know which managements will engage in prevent risk, and we want to prevent them. Number 7, how do we, if at all, account for the differences between market prices and intrinsic values? What collateral information do they examine? Well, I don't know how to answer that question other than to say that's what it's all about. In order to be a superior investor, you have to have a superior sense for the divergence between price and value. That's what it's all about. There's nothing else. It is our first job. To do this, you have to understand value. You have to understand the factors behind price. To understand price, you really have to understand what's going in the market, what I call the temperature of the market. Is it heated or cool? Are people eager or chasing? And so forth. And as I say, we have to know the temperature of the market. So in the book, my book, as you heard, is called The Most Important Thing. And for years I was asked, well, what's the most important thing in investing? And I would say, well, the most important thing is controlling risk. And then 10 minutes later, I'd say the most important thing is buying cheap. And then 10 minutes after that, I would say the most important thing is understanding market psychology. And so I put together first a memo 10 years ago, and then a book, 2011. And it has 20 chapters, and each one says the most important thing is, and it's a different thing. So chapter 1 says the most important thing is what I call second level thinking. I'll return to that in a minute. Chapter 2 says the most important thing is understanding market efficiency and its limitation. Chapter 3 says the most important thing is value. And chapter 4 says the most important thing is the relationship between price and value. But in a way, price and value is the bottom line. Everything else in the book is designed to help you figure out value and understand the difference between price and value. This one thing is really what your career, if you do it, will be all about. And if you think that price is here and value is here, and you don't buy, and it turns out that value is here and price is here, and you miss something, and everybody else buys it, you look bad. And if you think that value is here and price is here, you buy, but it turns out really that price is here and value is here, and you lose money, you'll look even worse. So there's no other reason to be in this business other than that. And I mentioned the first chapter, second level thinking. I'll just give you a few minutes on that because I think it's important. What we learned from the efficient market hypothesis is that the price of an asset at a given point in time comprises or is determined by the consensus of information of everybody. You know, the market's a voting booth, and everybody votes every day on what the price of every asset should be. So the stock's 39, and somebody says, no, I vote that it should be 39 and a quarter. How do they do that? They buy it at 39. Somebody else says, it goes to 39 and a quarter. Somebody else says, no, I think it should be 38 and 3/4. They sell it at 38 and a quarter, and enough selling, it goes down to 38 and 3/4. So the point is that the price of an asset on a given day is the result of an election held that day among all the investors. And so the price of an asset on a given day embodies all the thinking of the consensus, of the herd. Your job, if you're in the investment business, is to know when the herd is wrong. When price exceeds value or value exceeds price. If price exceeds value, you sell. If price is less than value, you buy. Everybody else is trying to do the same thing, or should be. And so if average thinking is embodied in the price, then to be a superior investor, you have to have above average thinking, what I call second level thinking. It has to be different from the consensus thinking, but different is not enough. It has to be different and better. So this should be your goal, to master second level thinking, and thus have a superior insight into the relationship between risk, price, and value. A couple of examples I give in the book. You know, the first level thinker says it's a good company, you should buy it. Second level thinker says it's a good company, but it's not as good as most people say it is, you should sell it. And I think that if you get that, you understand what we're talking about. John Maynard Keynes, almost 100 years ago, discussed a contest that was held in, I think, the Times of London newspaper. And they published the pictures of 50 girls. This is a terrible chauvinist story. I can't tell from this pleasant picture whether there are any women in the audience. But if there are, I apologize to them, and if not, I'm sorry for you guys. But anyway, the newspaper published a story of 50 girls, and it said they would give a prize to the reader who sent in a contest entry, and his entry ranked the 50 girls in order of prettiness, and the prize would go to the reader whose ranking was most like the average rank. So Keynes pointed out that the prize, the winner of the contest, was not the person who said which girl is the prettiest. The winner of the contest was the person who said which girl will most readers think is prettiest. You have to understand the difference. And that's the difference between first level thinking and second level thinking. And you can see how much more complex second level thinking is than first level thinking. Well, of course, then there's third level thinking, which says that, no, actually the prize goes to the reader who can say which girl the readers will say is is prettiest, or which girl most readers will say most readers will say. That's pretty hairy, but you do have to look beyond the simplistic. And anybody who thinks it's easy is really missing something. And by the way, I start just to make sure you'll buy the book. I start each chapter with a quote or an adage that I think is very appropriate. And one of the quotes leading off chapter 1 is from Charlie Munger, Warren Buffett's partner. And he told me one day at lunch, he says, you know, Howard, none of this is easy, and anybody who thinks it's easy is stupid. I mean, it just can't be easy to beat the market because so many intelligent people are trying, and they obviously can't. There's a great quote, which I just pulled out lately. I had lost it, I found it. It's from John Kenneth Galbraith, who I get half my good quotes from. And Galbraith said, there's nothing reliable to be learned about making money. Because if there were, everybody would learn it, and everybody with a positive IQ would be rich. And if you think about it, it's true. And I wanted to maybe in this section talking about this. In the investment business, if you're an engineer and you want to build a bridge, all you have, and they say how much steel should there be in the bridge, all you have to do is get the number right. Your job is to get it right. In the investment business, it's not about being right. If they say, well, what's going to be the earnings of Oaktree for this year, and you say a number, and it turns out to be right, you don't necessarily make money. And you certainly don't necessarily make more money than the next person. The way you make more money than the next person in the investment business is by being more right than other people. This is important. I hope you think about this for a minute. So if you're right and they're right, you don't make more money. So being right is not the key. If you're right and they're wrong, you make money. If you're wrong and they're more wrong, you make money. You don't have to be right to make money. And being right doesn't guarantee that you make money. What guarantees is if you're more right than other people. And that's why you have to practice second level thinking. And I hope you get that, because it's really important. And like I said before, if you can't figure out the difference between price and value, get another business. And similarly, if you can't understand the difference between being right and being more right, and if you can't be more right, then you get another business. Next, how do they define and manage risk? Well, you know, of the 20 chapters in the book, 3 are about risk. One says the most important thing is understanding risk. One says the most important thing is recognizing risk. And one says the most important thing is controlling risk. I really do think that risk is the most important thing. And I think that controlling it is our most important job on behalf of our clients. It's not hard to make money. It's especially easy to make money when the markets go up, like they did last year. Making money last year doesn't prove you're any greater shakes as an investor. And in fact, if I made 15% last year and you made 20, I got a shocker for you. It doesn't prove you're a better investor, because you might have just taken more risk. I'd like you to bear in mind that there are 3 ingredients, in my opinion, for success: aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, you don't need much skill. And so the accomplishment in investing is not making money when the market rises. It's making money with the risk under control, so that if it turns out that you're in a negative environment rather than a positive environment, you'll lose less. It's not about making money on the upside. It's about doing that and not giving it back on the downside. And to do the latter, you have to have risk under control. So I think that this is our first job at Oaktree. Our motto is that we avoid the losers, the winners take care of themselves. And I believe that very strongly. And we try to practice that every day. How do we manage risk? The answer for us is, again, risk is like pornography. We know it when we see it. We know when we should take it, when we should avoid it. I can't tell you how to do that. I can't tell you not because I won't, but because I can't reduce it to an algorithm. It's a matter of judgment. All this stuff is a matter of judgment. Nobody can give you an algorithm. I mean, if it were algorithmable, then as Galbraith says, everybody could do it. And if everybody did it, they would arbitrage away all the special opportunities, and then nobody could do it. So I think that it can't be reduced to a process, an algorithm, or something teachable. Your teacher is going to show you ways to try to do it, but not everybody will be capable of implementing them in a superior way as is required for success. And that goes for risk control too. Everybody at Oaktree knows that risk control is our first job. We say it all the time, internally and externally. We say that our number one job is not to make money, not to beat the market, not to be in the top quartile. Our number one job is to control risk. The clients who come to Oaktree, who have given us our $77 billion to manage, they came to us because they wanted risk control. Some of them wanted risk control more than maximum return. And as long as we give them what they want, then I think we'll have a good relationship and a successful business. So every analyst knows that his job is to understand the risk and to analyze it and tell the portfolio manager about it. And the portfolio manager's job is to put together portfolios of assets that have favorable, superior ratios of potential return to risk. And we don't have a risk management department. I don't believe that the job of managing risk can be separated from the job of making good investments. I believe that risk is the left-hand side of the probability distribution of outcomes. And the person who masters that distribution should know both sides well. In the last decade, financial institutions have been required to have risk managers and risk management departments. Are you all aware of that?
Yes.
Not so much. But anyway, take it from me. The important point is that I don't believe as much money was ever, or as much resources were ever devoted to risk control as in the last decade. And yet, we had the biggest financial crisis of the last 80 years. So I find it very easy to say that the so-called risk control profession is not, doesn't add a lot of value. Then the last question is, how do you make overall portfolio decisions and determine asset allocation? And when you think about combining individual assets and securities into a portfolio, then you have to think about each security's risk and potential return. You have to weigh them. And you have to take more of the ones that have a superior ratio of return to risk and underweight the ones that have an inferior ratio or avoid them. But when you think about assembling securities into portfolios, you have to think about a third factor. You have return, you have risk. Who knows what the third is? That's right. Correlation. Correlation is how securities act in combination in portfolios. So you can have 10 securities of the same risk and return, and they can produce one portfolio outcome. You can have 10 other securities of the same risk and return, and they can produce a different portfolio outcome because perhaps all of the securities in the first group respond the same to a given change in the investment environment, and all the securities in the second group perform differently in response to a given change. In that case, the first group is highly correlated, the second group is uncorrelated, the first group gives no diversification, the second group gives effective diversification. So it's very challenging to understand correlation because the analyst who follows Merck may know everything about Merck, but know nothing about how Merck will behave relative to Coca-Cola if there's a problem in the world. And that's an essential thing to understand when you assemble portfolios, but who's going to know that? And that is the job of the portfolio manager, but it's very difficult. And one of the reasons it's difficult is because there are fault lines, what I call, that run through portfolios that determine this correlation. For example, if you put together a portfolio of stocks in the drug industry, computer industry, steel industry, airline industry, hotel industry, and all the others, But in each case, you pick the biggest companies. Then your portfolio has a large company bias. And if something happens good or bad for the large companies, they may all be affected similarly. Equally true if you take all the small companies, or the rogue companies, or the high flyers, or the companies in one city or region, or the companies that emphasize one aspect of doing business. For example, what if you pick the company in every industry that makes the most use of social media? Well, then you'll be exposed to how social media does, and so forth. I'm exaggerating, but the point is, you have to understand the fault line. 1998, there was something called the Asian crisis. And lots of Asian economies got into trouble, and the markets collapsed, and there was real chaos. And what happened, or maybe it was an emerging market crisis, maybe it's more accurate to say that. But the point is that portfolios sprouted all these problems. Everybody knew that if there was an emerging market crisis, their emerging market stock holdings and bond holdings would get into trouble. They didn't think that their holdings of Coca-Cola would get into trouble. But guess what? Coca-Cola sells a lot of drinks in emerging markets. They didn't, and so the emerging market aspects rippled through the portfolio. And people found that a lot of their English bonds, German bonds, American bonds, large American companies, small American companies, companies in Italy, etc., tractor manufacturers and steel manufacturers, they all had problems because they were all connected, business-wise, to the emerging market. And so it's very important when you assemble portfolios to think about not just the return and risk of the component securities in isolation, but how they will perform in combination. Clearly, we look at price versus value. We look at risk versus return. You should also consider the quantum of risk, the absolute quantum. By that I mean that we all want securities where they have favorable ratios of return to risk. I don't know if your approach will lead you to quantify these things, but let's say it does. And you can find all the securities with very high ratios return to risk. But I think it's legitimate to say that we will not go beyond a certain absolute quantum of risk, either qualitative or quantitative. So even though of the 20 securities, they all look good on the ratio of return to risk, maybe 5 of them, the absolute amount of risk is too high. We're just not going to take that. That's not what our clients want. That's not what we want. So ratio of return to risk is not enough. You have to look at the absolute quantum as well. We want to diversify our portfolios, which means we want to control the correlation. Basically we want to, here's a good rule for you. It's a good idea to hold more of the things that go up and less of the things that go down. It's like, none of this can be simplified into a fail-safe algorithm. And it all comes down, in the end, to judgment. Basically, you want to be bold when prices are low and conservative when prices are high. You want to overweight the things that are statistically attractive, but you don't want to overrate your knowledge. And you want to always leave margin for safety. So with that, I think I've told you everything I know. If you have any questions, I'll be glad to take them for a little while.
Okay, thank you very much.
Hi, Mr. Marks. I just wanted to say great book and great quarterly memos. My question is with regards to Japan. My question is with regards to Japan. You have a country with the worst sovereign balance sheet in the world. As well, you have geopolitical risk. You have risk with debt service. You have 25% of their government revenue going to service debt. As well, you have risk with the aging population. Yet you have government bonds yielding 86 basis points and CDS around 80 to 90 basis points. My question is, what is your outlook on the Japanese government bond market and whether you foresee the potential for a fiscal crisis within the next 5 to 7 years?
First of all, you should know that nobody knows everything, and certainly not me. And you know, I don't claim to have pronounced expertise on macroeconomies, and certainly not ones outside this country. I was at a dinner last night where I heard a case, so the good news is I can parrot it to you. And this guy made a very strong bull case for Japan because he felt that they were going to take significant governmental action. Things like weakening the yen. And of course, the weaker your currency, the more likely it is that foreigners will buy your goods, and the less likely it is that your people will buy foreign goods, and that has an ability to improve business for your exporters and redress the balance of payments, balance of trade. That's number one. That's an example. Another thing he told me, which I thought was rather clever, is that you know, the trouble in Japan is that nobody spends any money. They're really conservative, and they just pile it up. And all the old people have all the money, and the young people can't get much money. So he felt that they would raise the inheritance taxes and increase the amount you could give tax-free to the next generation. And that would cause money to be shifted from the older people to the younger people, and that if you put money in the hands of the younger people, they're more likely to spend it. So this makes sense. And if you have a smart government willing to do these things, I think it can make a difference. Now, you have rightly picked on Japan, which has some very bad debt statistics. And the other thing is Japan has developed an extremely undynamic economy. I don't know if you get ESPN up there, but
TSN.
Well, CSN is not the same as ESPN. And on ESPN, Chris Berman says they've lost their schwerg. And I think that the people in Japan have lost their schwerg. And they're not thinking big, they're not thinking progressive, they're not behaving entrepreneurially. I think that my understanding is that fewer Japanese kids are coming to school in the West than ever before because they just got that interest in taking that step. So they have to restart their economy. Maybe some of these steps can do it. On the other hand, in answer to your question, your statistics on Japan are dire, but the statistics on most of the world countries are pretty bad. And since I'm not a macro guy, I absolve myself of the responsibility for knowing how any of this is going to improve. Other than Canada, of course, you guys are quite conservative, But most of the world's a pretty big mess.
Thank you.
Hi, Mr. Marks. I just want to start by saying thanks a lot for presenting to us. I learned a lot from the presentation. My question is regarding risk. So in the value investing class, two ways that we measure risk are by looking at business and financial risk. And when we're looking at financial risk, we're looking at the rating agencies and what the ratings are for particular equity securities. I was just wondering, what sort of role do the rating agencies and their ratings play into your decision making when you're looking at distressed debt?
That's my favorite question in the whole world. It gives me the opportunity to use a line that I used 10 years ago. The role of the rating agencies is to be wrong. Because when they rate a company too high, then it issues too much debt too easily and gets into trouble and becomes distressed, and we get to buy it. And when they rate a company too low, then the debt yields more than it has to, more than it should, and then we get to buy it and we earn excess yield. So if you could, you might say that my career has been, has consisted of taking advantage of the errors of people like the rating agents. And, you know, the government in the United States has passed laws which respect the rating agencies. And yet the ratings agencies do not have a record of doing superior second-level thinking. And they can add up the numbers, and they can add them up no better than you. And if hopefully I and my colleagues can add them up better. And one way to make money is to be better than the others, and that includes being better than the rating agencies. By the way, here's a good one for you. If you want to make $1, even a Canadian dollar, this is a two-part question. Question one, how many American companies are rated AAA by S&P today? I'm going to look for my bottle cap while you think about it. Anybody gets $1?
20.
4. What are they? Anybody?
Microsoft.
One.
Johnson.
Johnson & Johnson. 2.
Exxon.
3. $5 for the fourth one.
ADP.
ADP. I said it first.
I think there was a lag.
That's true, there is a lag. All right, then here's the other half of the question. How many AAAs did S&P issue in the mortgage boom to collateralize mortgage security compared to the 4?
1,000?
16,000. What do you think of the rating agency? Say no more. How many of those AAAs are still solid? So, you know, I just can't muster much enthusiasm for the rating agency. And remember that Moody's is the one that said that single B securities fail to possess the characteristics of desirable investment. And I haven't looked lately. I'll bet they still say it today. Next question.
Thank you. Hi, Mr. Marks. Thanks for taking the time to speak with us. As of recently, we've seen a number of municipal bankruptcies in the United States. Have you been an active participant in that market? And if so, do you find the inefficiencies to exist there?
No, we don't buy non-corporate securities. We never have. I believe that buying governmental securities at any level, sovereign countries, states, cities, municipalities, agencies, well, I mean, you could do it on revenue bonds, I guess, or project finance where there's an asset and a revenue stream, assuming they didn't screw with it. But buying government bonds does not require economic analysis. It requires political analysis. Can they pay is not sufficient. Will they pay? And, you know, there's so many muni issuers out there that clearly will never be able to pay. But the question is, will they be able to roll over their debt? Will they find alternative ways of paying? Will they get bailed out? These are the important questions. You know, here's an interesting question for you. You look at these municipalities, and I'm not talking about the small cities that have gone under in the last 2 years, but you look at the states of the Union. The interesting thing, if you think about it, well, and, you know, I don't want to get too metaphysical here, but, I mean, none of them can pay their debts. I don't think the United States can't pay its debts. I don't think many or any countries in the world can pay their debts. Maybe some emerging markets which have low debt and productive economies. think about it, who knows a AAA country? Who can name a AAA country?
Canada.
All right, there you go. Okay. So, could Canada pay their debts when they all came due? I don't know. I know America couldn't. What countries can do is what companies can do, lots of people can do with their credit cards, is that they roll their debt over. And I know that, look, what if people refuse to lend money to California starting tomorrow? You think California can pay its debts? Or almost any other country, a state in the union? So the creditworthiness of these borrowers, especially these borrowers that don't make money, nothing to lend to a company that makes money. But these entities lose money. They spend more than they bring in. That's the opposite of making money. Rather than profit, they have deficits. And you know, the essence of lending money to them is the belief that they'll be able to roll their debts. And that is not an economic decision. We've never invested in government credit, which is the answer.
Thank you.
And by the way, remember, I think I might have said at the beginning that the way we manage money is not the only way to manage money. There are lots of things that I think can't be done well, and there are people who do them well. Like sovereign investing, muni investing, gold investing, macro investing, algorithmic trading, you know, all the things I'm biased against. There's somebody out there doing them well, but not many. That's all I can say. Next case.
Hi, Mr. Marks. I just had a question with regards to the stressed debt environment in the U.S., and more specifically in the power sector, where you have a lot of highly levered companies that refinanced in 08, but at the same time you've had gas prices kind of get killed, and so you have all these, power plants in the U.S. But at the same time they're very highly levered, and the debt's trading at extremely low levels in the 20s, and similar with the bank debt. So I was just wondering, what opportunities do you see there within, say, your fund or other funds interested in it?
Well, I think we will see bankruptcies in the power sector, and thank God. That's where we get our opportunities. Now, the fact that something goes bankrupt doesn't make us money. The process has to be that it goes bankrupt. It scares the hell out of people. They run out of securities, and we can buy them for less than they're worth. That's the process through which we make money. I imagine we'll have some of those in the power sector. So I welcome your question. Thank you.
Can you tell us about a time when a deal didn't go your way, perhaps in the SoundCloud example or another one, what your approach is, and if you have any lessons for us?
Well, Will Rogers is the one who said that the secret to making money is common stocks. If they go up, sell them. If they don't go up, don't buy them. So that's my advice. But I mean, we have to learn. And most of us learn through experience. And the definition of experience is that experience is what you got when you didn't get what you wanted. We all make mistakes. You'll make lots of mistakes. And it's like when you go out to play tennis. You shouldn't think that you're going to not hit any double faults. If you don't hit any double faults, you're probably not serving hard enough. But you'll go out, you'll make investments. You'll make mistakes, you'll lose money. The key, of course, is to learn from it. So after we had the sound card example, we didn't make any more technology investments. No rule is absolutely right, but that we determined was a good rule for us. We haven't had a lot of losers. I will say that we had that one in technology. We had one company in a sovereign country that decided not to pay us and not to give us the assets securing the bond. So we sued them. We got a judgment against them in New York. and they got an offsetting judgments against us in their, I don't want to point any accusing fingers at any countries, but in Jakarta. So we lost some money on that. We bought the bonds of a Argentinian shoe country, a shoe producer, and it turned out that the financial statements were fraudulent. So, you know, you're going to lose money. The only thing you can do, I can't generalize. You know, the only generalization I can give is don't make bad decisions. Don't be guilty of the same over-optimistic assumptions as other people are. But the most important thing is that you learn from your experiences.
Thank you.
Last
Sure.
question.
So I guess this also goes around the distressed debt area.
By the way, excuse me, I'm going to have to make this the last one, or my wife will kill me. The most important rule is happy wife, happy life.
I think that's third level thinking then. So in regards to distressed debt, you mentioned that you have lower IRRs, but since it would be compounded over a long period, you'd be actually making more money to your investors. So over time, the economic cycles are getting shorter and shorter, so you're being able, I guess you're taking less overall growth, but you're getting a higher IRR. So how does this affect your investing strategy in regards to what you're doing now?
You know, that's beyond our control. All we can do, that doesn't, I don't think that affects what we do. All we can do is buy things for less than they're worth. And we can't really tell how long it's going to take to resolve the environmental issues, the macro issues. By the way, you say economic cycles are getting shorter. I think that's a pretty good example of overgeneralization. How many economic cycles have you seen? You know?
I'm referring to an academic standpoint. I haven't seen them as well.
Yeah, but there's a tendency to say that the first one was 20 years ago, the second one was 12 years ago, the last one was 5 years ago, so they're getting shorter. But you know, it may be a trend or it may be a blip, and I don't subscribe to what you say. And by the way, if we learn the lessons from the last one, then hopefully the next one won't be too slow. And by the way, I don't think the economy is going so strongly that we have to worry about a collapse anytime soon. Because normally it's boom bust, and I don't think we have a boom, so I don't think we're going to have a bust anytime too soon. We're just going to have a rather sluggish recovery. Thank you.
Mr. Marks, I just want to ask the last question, okay, because I always do. And I know you wrote the book, The Most Important Thing, but truly, what's the most important thing in life, in investing, that you learned over the last 20, 30 years?
I would say, keep your eyes open, think about what you're doing, think deeply, Don't just think, well, you know, I buy things at 2 and they go to 5. Understand the process. Understand your process. Understand your limitations. Understand what you believe in, what you don't believe in. Do you believe in forecasting? Or do you think that forecasting doesn't work? Do you believe in taking high risk, or do you believe in risk control? These are the important things. And, you know, your investment philosophy can't be, I buy semiconductor stocks. You have to build a philosophy about some things that are kind of eternal verities. And so you have to think big, and you have to think serious. And I think that the really good investors that I know really understand themselves and their process and their world and think deeply. And that's my encouragement to you.